My thumbnail was not a clickbait because I really got fined by the IRS. I didn't pay close enough attention to my tax withholdings, and I promise I will explain what happened later on in this video, and I will be completely transparent. And a simple tax mistake could happen to anyone, and I want you to be ready for 2024 when you file your taxes for 2023. But you need to start correcting these mistakes now so you don't get screwed by the IRS. So mistake number one a lot of people make is not having all of their paperwork before they file their taxes. You need to wait until you get all of your 1099s or other tax statements before you file your taxes to the IRS. But how do you know if you got all of your 1099s? You need to first have all of your accounts written down on the spreadsheet. I organize my bank and investment accounts by keeping all of those accounts organized. So I know that I'm gonna get 1099s from those banks. And this 1099 is the most common one. And I have my checking and savings accounts with Ally Bank, Schwab, and Chase. So I expect to get a 1099 INT, which stands for interest, from those banks, right? So I know they have to send me a copy of my 1099 INT by January 31st because that's when they file the same 1099 to the IRS. You could also get what's called a 1099-R, which stands for retirement. If you're retired and withdrawing from your retirement accounts, you're gonna get a 1099-R every year by January 31st. This includes your IRAs, annuities, 401k, pensions, insurance contracts, and survivor income benefit plans. And I get a 1099-R every year because I do a backdoor Roth IRA conversion. So when I do a backdoor Roth IRA conversion, I'm making a non-deductible or after-tax contribution from my checking account to my traditional IRA and then make a non-taxable conversion from my traditional IRA to Roth IRA. So I'm gonna get a 1099-R from my traditional IRA because I technically did a distribution from it and then put it in my Roth IRA due to my income limits. What I also need to do is fill out what's called an IRS Form 8606, which is to report that my traditional IRA contribution was non-deductible and show proof that the money I put in my traditional IRA was in after-tax dollars and not pre-tax dollars, which also shows proof that it was a backdoor Roth IRA conversion and not a taxable conversion. And I know this might not make sense, so let me just draw on this. So typically the IRS thinks that my contribution to my traditional IRA is in pre-tax dollars, but I can't do it because I exceeded the traditional IRA income limit. But in order for me to prove that the money I put in my traditional IRA was in after-tax dollars, I have to fill out the IRS Form 8606 to say that the money I put in my traditional IRA was in pre-tax or after-tax dollars and then put it in my Roth IRA. You can also watch this video about the backdoor Roth IRA conversion linked in the description below. And if you invest your money in a taxable brokerage account that pays you dividends every year, you're gonna get a 1099 div from your broker every year by January 31st that shows whether you owe taxes on qualified dividends or ordinary dividends. Your qualified dividends are taxed at long-term capital gains tax at 0, 15, or 20%, depending on your total income. Most of you watching this will pay either 0 or 15%. Your ordinary dividends are taxed as ordinary income tax. So if your marginal tax rate is at 24%, then that's how much you'll need to pay for your ordinary dividends. I have several videos about dividend investment strategies on my channel, so just feel free to check them out. And if you make any Venmo, PayPal, or other third-party payment processors for more than $600 in any amount of transactions, you're gonna get what's called a 1099K. So let's say you sold a ticket to the Taylor Swift concert for $500 because it's under the $600 threshold to get a 1099K. You still need to report that profit that you made from the Taylor Swift concert. And even if you don't receive all of your 1099 forms, you're still responsible to pay the taxes you owe. The last thing you want is for the IRS to come knocking on your door and say that they're gonna audit you because your numbers are off, right? You have to keep your finances organized and know when these 1099s become available before you file your tax return. And I know these taxes and finances can be confusing and frustrating. So I encourage you to join my private Facebook group or become a member of my channel, because I have a public live stream and private group session every other Wednesday to talk about all kinds of financial independence, investment, and early retirement strategies. You can visit firesidechat.com/pricing or firesidechat.com/coaching to schedule your financial coaching session. And mistake number 2 is more for people with side hustles, but not keeping your personal and business expenses separate. People also misunderstand that if you get an LLC, then your tax structure becomes different. That's not the case at all, because getting a single member LLC won't change the way you pay your taxes as a sole proprietor. Let me give you my example. I have a financial coaching business to help my clients get out of debt, organize and budget their finances, and provide financial education. The income that I make from YouTube, TikTok, Facebook, Instagram, and my private clients are all going into my business checking account. But when I file taxes, that income is still taxed as a sole proprietor. So if I have a 9-to-5 job that pays me $100,000 a year, and my financial coaching business, let's say, brings me $50,000 a year, then my total taxable income becomes $150,000. The single member LLC has nothing to do with my tax structure as a sole proprietor, because the purpose of the LLC is to limit my liability and provides protection against my personal assets. It just means that my Fireside Chat business exists as a separate entity from me. My channel name is Fireside Chat, but on my tax form, it'll show Fireside Chat LLC. But if I want to save money on taxes because my Fireside Chat business brings in more revenue and net income, then I can restructure my business to either an S corporation or a C corporation. If I just want the common stock and get paid in salary for my business, then the S corporation might be right for me. If I want to go public one day with my business, then the C corporation might be right for the business. I'm going to do a more in-depth video about this in the future, so be sure to subscribe if you haven't done that already. In the state of Nevada, where I reside, I have to register my business to conduct my business. And I can't speak for every state, so make sure to look into your state laws before starting a side hustle. But in my case, the reason to have an LLC was so that I could expand the company and have more ownership shares in the future if I turn it into an S Corp or C Corp. I also wanted to protect my personal assets from financial and legal liability. But it's crucial to keep your personal and business expenses separate to avoid piercing the corporate veil. As a business owner, I have to make sure that I don't lose limited liability by properly documenting my business transactions, legal statements, and disclosure agreements. My business expenses are tax deductible, so if I spend $30,000 in business expenses and made $50,000 in business income, then my taxable income could be reduced to $20,000, right? And if I have my personal expenses mixed together, it's gonna be extremely difficult for me to identify what's what. If someone sues me or my business and I have my personal assets mixed with my business assets, then my personal assets might not be protected against a lawsuit. And that's what piercing the corporate veil really means. But the most important thing you need to do is open a separate business checking account, savings account, and credit card to keep the income, expenses, and fees completely separate from your spouse, your 9-to-5 job, or your other side hustles. This applies to your rental income as well, and you need to keep those things separate. And don't forget to download my financial independence resources for absolutely free by visiting firesidechat.com/resources. You should also check out my Fireside Chat shop to check out the books and equipment I use for my YouTube studio at firesidechat.com/shopping. And mistake number 3, which is the mistake I made in 2022, was not checking to see if my paychecks had enough federal tax withholdings. And I got married in 2021, so my tax structure went from a head of household to married filing taxes jointly. And when I made that change on my W-4 tax withholding form, my employer automatically assumed that I was the only one bringing in the income to the household. My employer does not know how much money my wife made in 2021 or 2022. So my marginal tax rates were only based on the income that I brought in from my employer. So let me hide my face here and give you an example. So what basically happens is that if spouse 1 makes $100,000 a year and spouse 2 makes $100,000 a year, each of those spouses' employers only taxes you from 10, 12, 22, or 24% and beyond. So each of the spouses will be taxed at 11.4% in the effective tax rate. In reality, what the employer should do is tax 10%, 12%, 22%, and then tax the other spouse's income starting at 22%, and then 24, 32, 35, or 37% if the income is even higher, right? So there was a gap between my federal tax withholding and my wife's tax withholding. These are not my real income numbers, but this demonstration shows the mistake of not withholding enough taxes throughout the year 2022. My effective tax rate of $100,000 will be 11.4%, and my wife's $100,000 would also be 11.4% because our employers don't talk to each other, right? And it should have been 16.55% in the total effective tax rate. So we undercontributed our taxes by about 75% when it should have been at least 90%. So the IRS penalizes you 5% of the underpaid amount, and they're capped at 25%. So basically, we ended up paying the interest on the underpayment, which was 6% for the fourth quarter 2022. It just depends on what the Fed funds rates were at the time. So for example, if I owed $5,000 in taxes for the year, but only paid $2,000, then I underpaid my taxes by $3,000, right? Because I didn't pay at least 90% of what I owed, or $4,500 for that tax year. The penalty would be the federal short-term rate plus 3%. So it was $3,000 multiplied by 6%, and the penalty was $180 in interest. And as soon as I realized the mistake I had made, I made some adjustments to my W-4. You can request to make changes on your W-4 with your employer's HR. This is not specific tax advice, it's just what I did. And I talked to my CPA and realized that I needed to close the gap that I talked about earlier. So under Step 4 and Block C on Form W-4, where it says extra withholding, I asked my employer to withhold an extra $200 per paycheck. This also depends on how frequently you get paid, because I get paid every 2 weeks. That's 26 total pay periods. With $200 per paycheck, that's a total of $5,200 in extra tax withholding, right? So if you're married and filing your taxes jointly and both spouses bring in some kind of income, you need to adjust your W-4 to make sure that your employer is withholding enough taxes for the year, or you're going to be penalized with interest for underpaying your income. If you have a side hustle bringing in substantial income, you need to increase your tax withholding or make quarterly tax payments with your CPA. And this mistake commonly happens to people who recently got married or changed their tax filing status. You can always go to the IRS website and Google search tax withholding estimator to find out how much taxes you're going to owe for the year 2023. Do not underpay your taxes or you're going to be penalized by the IRS, especially when the interest rates are at a 15-year high. And mistake number 4 is thinking that a big tax refund is a good thing. A big tax refund is common if you change your tax filing status from single to married and file taxes jointly, because as a single person, you pay more in taxes. When you get married, your taxable income is reduced almost by half. If you know that you're getting married this year, you need to update your W-4 and make sure to change your filing status. And I wouldn't do it until after you get married though, just in case someone gets cold feet. And remember that a tax refund is not free money. You're having the IRS keep this money in their treasury, basically interest free. So if you get a $5,000 tax refund this year, it means that last year you gave the government a $5,000 interest free loan with a 4% APY with a high yield savings account. You just missed out on $200 in interest. With an index fund investment, that's $800 if your stocks made 8% in total return. I want you to have higher paychecks rather than getting a big tax return at the end of the year. You have to ignore all of these news headlines about how you're going to have less money in tax returns in 2023, because what you really want is to keep $0 in taxes owed. And if I end up owing the IRS money, that means I under-contributed my tax withholdings. If I end up getting a tax refund, that means I overpay my tax withholdings. You need to make sure that your W-4 form is in order so that your taxes are squared away. And mistake number 5 is not having a CPA and doing taxes on your own. If you just have a W-2 job with one source of income, then you probably don't need a CPA to prep your taxes. But if you need help making a complex financial decision like winning the lottery or something complicated that requires tax advice, you should get with a trusted CPA. I should really make a video about what to do when you win the lottery one day. If you're getting married or about to have a child or adopt a child, you should get with a CPA. And when I started my business, I got with a CPA to make sure what qualifies as business expenses and what doesn't. What's amazing is that all the legal fees are actually deductible from my business income. If you're thinking about whether a CPA is worth it or not, when you start a business, you have to think about the ROI that you're gonna get from a CPA. Let's say you paid $500 to a CPA for a consultation. You could protect your business by making the right financial decisions that could save you thousands of dollars in the IRS fines. By paying a CPA, you could have a better projection of your taxes this year so that when you file a tax return next year, you know what to expect when the tax deadline approaches. Another example is if you receive a large sum of money from someone because he or she passed away, or you win money at the casino or even a lottery. You need to make sure that you're prepared when the tax season comes. I know I sound like I'm trying to sell you a CPA, but this is all based on my experience. You also want to make sure to do your due diligence to find a trusted CPA before hiring one. You want to find someone who can educate you on the tax system and how your taxes could look like in the coming year. And if you want to know more about how to pay $0 in taxes when you retire early, be sure to check out these two videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.